Most people think their credit score drops only because they missed a payment or maxed out a credit card. But the truth is, your credit score might be tanking right now because of 5 everyday purchases you don't even realize are hurting you. And the worst part? These are purchases almost every American makes, sometimes every single month. So if you've been working hard to improve your score, but it still looks stuck, or worse, it randomly drops for no reason, this video might finally explain why. Let's break down what's secretly damaging your score, and more importantly, how to stop it immediately. But before we get into the list, I want you to think about this. How many times have you opened your banking app and seen a lower score even though you paid everything on time? How many times have you wondered, why is my credit score not going up? Or, what am I doing wrong? I don't even use my card that much. Well, the reason is simple. Your credit score isn't just about paying bills. It's about how banks interpret your behavior. And sometimes you might be doing things that feel completely normal. But to lenders, it looks like risky financial behavior, even if it's not. Maybe you bought something in full and your score dropped. Maybe you paid off a loan and your score dropped. Maybe you used a card once and your score still dropped. This confuses millions of Americans every single month. And that's why today's video is important, because if you fix these 5 hidden purchases, your score can actually go up way faster than you think. Let's jump into the first one. Problem 1. Buy now, pay later purchases, the silent score killer. Affirm, Klarna, Afterpay, PayPal Pay in 4. Sounds harmless, right? They make shopping easy, convenient, no interest, small payments, all good things. But here's what most people don't know. Buy now, pay later is now reported to credit bureaus in the US. And if you miss even one tiny payment, your credit score can take a massive hit. But it gets worse. Even if you pay on time, BNPL can still hurt your credit score because it increases the number of accounts you open. It shows lenders you need short-term financing for small purchases. It spikes your new credit activity, and it increases your risk profile. To a bank, frequent BNPL usage looks like, this person is struggling with cash flow, even if you aren't. So that $40 shirt you split into 4 payments, that $80 grocery bill, that $120 Amazon cart, those micro purchases can signal financial stress. And the credit bureaus track every single one now. Bottom line, BNPL can damage your score even if you're doing everything right. We're just getting started. Number 2 is even worse. Problem 2. Using your credit card for subscriptions. Netflix, Spotify, Disney+, Apple iCloud. Small payments, harmless, automatic. But here's the danger. Subscriptions cause accidental high utilization spikes. Why? Because subscriptions hit your card before your paycheck hits your bank. So let's say you have a credit limit of $300, very common for many Americans. You get charged $15 Netflix, $12 Spotify, $10 iCloud, $17 Amazon Prime, $30 gym membership. These tiny charges add up and can push your utilization above 30%, which is the danger zone for credit scores. And guess when most credit card companies report your balance? Before you pay it off. So even though you clear your balance later, the statement that went to Experian, Equifax, and TransUnion already shows high utilization. This alone can crush your FICO score. Solution? Move all subscriptions to a debit card or a high-limit card with no utilization risk. But let's keep going. Number 3 destroys credit scores faster than any other purchase here. Problem 3. Large, one-time purchases on small-limit cards. You buy a new phone, a laptop, furniture, some appliances, maybe a last-minute flight. Nothing wrong with that. But if the purchase is big and your card limit is small, your utilization skyrockets instantly. Example, if your credit limit is $1,000 and you buy a $700 phone, your utilization hits 70%. Even if you plan to pay it off next week, lenders don't see that. They only see the snapshot reported on your statement date. And high utilization is the biggest factor for score drops, even more than opening new accounts. Many Americans don't realize this. Your score drops before you even pay the bill. Here's the rule. If you must make a large purchase, call your bank and request a credit limit increase first. If they deny it, use a card with a higher limit. Worst case, put half on debit and half on credit. Never let a single purchase take your utilization beyond 30%. All right, number 4 is something almost nobody talks about. Problem 4. Charging everyday expenses on credit. Gas, groceries, coffee. Gas stations, Target runs, Walmart groceries, Starbucks, DoorDash. Millions of Americans swipe their credit cards for these everyday expenses. It feels normal. It builds points. It's convenient. But here's what most people never realize. These purchases drain your available credit early in the month and push your utilization high before you get paid, which leads to higher reported balances, credit score drops, more interest if balances carry, lower approval odds for credit increases. And the worst part? Everyday expenses never stop, so your card is always in usage and the bureaus see consistent high activity behavior. Lenders hate that. They want to see low utilization plus predictable payments, not daily swipes, spikes, dips, and randomness. This one change alone can boost your score massively. Put daily expenses on debit or on one dedicated high-limit card only. Now let's get to number 5, the most surprising one. Problem 5. Emergency purchases on credit cards. Unexpected car repair, medical copays, vet bills, home repairs, last-minute travel. Life happens, emergencies happen, and credit cards feel like the easiest safety net. But here's what the credit system thinks. This person is financially unstable, even if you aren't. Emergency purchases usually cause high sudden spikes, maxed out cards, panic payments, missed due dates, interest accumulation, and statement imbalances. All of these trigger risk flags in scoring algorithms. And here's the hidden factor. Lenders analyze purchase category data. They see when you spend on auto repair, medical, urgent travel, home emergency services. These categories statistically correlate with higher default rates. So even innocent emergency spending affects your score. The fix? Build a $300 to $500 emergency buffer in a checking account. It reduces 80% of emergency credit usage. So to recap, the 5 purchases secretly killing your credit score are buy now, pay later apps, subscription charges on credit, large purchases on small limit cards, everyday swipes like gas and groceries, and emergency expenses. If you fix even 2 or 3 of these, you'll start seeing your score rise in the next 45 to 60 days. And now I want to hear from you. What credit card do you use right now? Comment the name below. I'm going to make my next video specifically on how to increase your credit score using your credit card. So drop your card name in the comments and I'll break it down for you in the next upload. Thanks for watching. This is Finance Builder and I'll see you in the next one.